Thank you very much, Mr. Swaminathan, for giving us this overarching picture and where the banking sector and the regulator wants the banking sector to head. I must tell you that you spoke of brickbats. I've not heard of so many. When we ask bankers and NBFCs for any reaction to the Reserve Bank, it's usually very, very cordial and positive. Of course, they check with us, is it on the record or off the record? So, the response also depends on that. But I must say, jokes apart, that the fact that, the first point you made, that, unintrusive supervision, removing outdated regulations and filings, that's something that's coming for very high praise. I mean, there are people who say that all the Reserve Bank asks us now is just give us your login and we will check whether the processes are there. Extremely, that's coming for a lot of praise. I'm going to wear my journalist hat and ask you questions, which were not covered. One of the big talking points, of course, is that, deposits are becoming very, very hard to come by. You've been a commercial banker, now a central banker. What's your view? Is this structural? Because if you take if you ask people under 40 over here, I don't think any of them even have an FD. So has something structurally changed about deposits?
Yeah, thank you, Lata, for having me here. It's a pleasure to be participating in this event. It's a good question to start with. You said deposits are hard to come by. Maybe I would like to slightly put it differently, because if you look at the numbers on a year-on-year basis, deposits are still growing at about 11-12%. It's not that that there is a contraction or there is a degrowth. Deposits are still coming at about 11-12%.
They're growing slower than loans.
Yeah.
That's it.
So the only context, as you rightly said, is when seen in the context of the rate of growth of credit, it seemed to be not keeping pace. So that's the context in which the discussion comes up. What we need to also see is that these are cyclical, and we have seen times in which the deposits grew almost twice as that of credit. We had a couple of years of that nature as well. We had 8-9 quarters when deposit was outpacing and banks had to find ways to manage the liquidity that was flowing in. And today you have a situation where the demand for credit is more, and aided by digital lending, the money has become mobile. So the growth is going good. But coming to the second part of your question, is structurally something different. But I think this is something which we'll have to understand, that this is a generational shift.
Yes.
Today, the younger generation have more options and are also willing to take a bit of a risk in terms of variety as well as chasing better returns. So deposits becoming a choice of senior citizen is not something which we should be surprised of. This is a part of the evolution. So whether it is debt funds or equity funds or index funds or investing in properties or gold, there are multiple options for financial savings today. And this will be typically cyclical, and I'm sure that people will find the best way to manage their savings. Okay. So as long as that savings do take place in some form or the other, we should not be much worried. And one last line, again, to deal with the structural part, as a regulator, what we have done is, in the last couple of MPC statements, we have just sensitized the lenders that if this gap is allowed to continue for longer, it may create a structural liquidity risk for some of the banks or financial entities who are already in a high CD ratio. That's the part, and I'm sure that they are competent enough to see what is emerging in front of them and let them handle.
Okay, then that's the follow-up. You have, like you said, in the past, two policies warned, or rather mentioned, highlighted, that credit deposit cannot have such a gap. Are you satisfied with the progress?
See, there is no golden number or an ideal number that we can chase in these matters. So whether we are satisfied or not satisfied is difficult to respond to.
Trend.
But if you look at the trend, you are right. The incremental CD ratio is certainly moderated. That is one part. And we are also seeing the deposits are also growing, and we've seen banks augmenting their product offerings. Banks are also talking about improving their service quality so that they place themselves as a choice to the generation which would like to explore various options.
So you don't see yourself taking any steps to encourage? You think that the trend is already in the right
Absolutely
direction?
no steps required at this point in time in our view, because we have told the boards to strategize, recalibrate, basis their scale and complexity. So it is left to the commercial wisdom of the entities rather than a regulatory prescription.
You know, this understanding that youngsters are saving through capital markets and not through FDs, many public finance economists point out that anyway, even the capital market money is in the banking system. So, you know, what exactly has changed in that case? Instead of
has
FD,
changed.
it is in current account, is it?
Yeah, I don't think anything has changed, because money will finally have to find its place. It will be back in the banking. If not in retail deposits, it could be in deposits that comes through the markets. So that way the money has the same velocity, and it has got to move within the corridor which is allowed unless money is remitted abroad.
Yes.
Other than that, I'm sure
I
that
mean,
the
that
money...
leaks
So the economists,
out.
what they are saying is fine. I think when you have two economists, you will have three opinions. So I think I'm not competent to make a fourth opinion on that.
Okay. No, the reason why I'm asking you is that if the money is going only as current account, from FD, it's a larger part of the money probably is going as current account. Would you, a part of the reason why the slowness has come is, slowness in deposits has come, is probably because the Reserve Bank created less reserve money in the previous year, for the simple reason that at that time you all were chasing inflation. So do you think it is cyclical? Do you think it's a matter of time? And if it is a matter of time, by when do you think loans will, go below deposits or
I
deposits?
think so. I'm not I'm not in a position to respond to that particular analogy. Maybe you reserve this question for the MPC.
Okay, then the other thing that you raised even in your speech, the markets, the financial sector is in a high point. But in this high point, you have been pointing out that unsecured loans are a matter of worry for you. MFIs are a matter of worry for you. How much has the worry abated, or do you think it is still a matter of worry?
Again, I would like to be categorically clear that whatever financial parameters that we are tracking, at this point in time, certainly there is no worry or a concern, because if you look at the slippages, if you look at the credit cards, if you look at the GNPA, NNPA, or the SMA, as we call it, whether it is 30 plus DPD or 60 plus DPD, none of these numbers are showing any trend that is likely to become a worry or concern. They all seem to be behaving fine. But if you compare them with the situation a year ago, probably there is a slight uptick. Anticipating this, we took some preemptive measures already, as you would know, in November last year. We saw certain outlier growth in certain segments where we thought there could be a possible risk build-up. On those segments, we called out and added certain risk weight, which was a very clear signaling device. And if you look at the last 2-3 quarters, those segments are moderated. So I think that the measure that was taken, which was preemptive, has had its effect. So we see a moderation at this point in time. And as regards the little bit uptick that we see in some of these parameters, while it is not yet a matter of concern, again in the last MPC statement, if you would recall, we have requested the lenders to strengthen their underwriting standards and also step up on their collection and recovery process so that we don't end up in a situation where there are elevated risks. I think that must be good enough.
Would you say we have peaked in terms of the high, and now we should be prepared for the financial high cycle to start down cycling a bit?
No, but I think we wish that the party continues.
Okay. Thank you very much, sir. On that very positive note, thank you very much for joining us.
Thank you, Mr. Swaminathan and Lata, for that engaging discussion. Moving on to another enriching discussion titled Redefining Banking Excellence, Navigating Challenges and Opportunities. The banking sector is at the forefront of significant transformation, and banks must continuously innovate and adapt to meet the demands